Hey guys, it's Seth and Paul for the Everything Money Channel. Today we analyze Google stock. Google is a company. Paul uses his 8 pillars when looking at a stock: free cash flow, decreasing shares, profit growth, revenue growth, all of it right now on the Everything Money Channel. Let's do it. Paul, we have yet to actually analyze Google stock.
Which I'm kind of surprised about.
Google's incredible.
Yeah, it's an incredible company.
Is it ever going to... I always marvel, like, remember the days of Yahoo or Ask Jeeves? I mean, something about Google, I think the simplicity of putting one bar, search anything, it's just incredible. And how they've expanded into, like, business listings and... I mean, I certainly
They're an advertising company, basically.
Yeah, they do great.
Yeah, they do phenomenal.
And they always hear the wonderful stories about working there and how incredible it is. So...
By the way, here's a prime example of me being wrong.
Go on.
I was offered Google stock as part of the IPO because the bank I was with led their IPO, and I said no because it was too expensive. At $60 a share, I think it was. 60 or 80.
Too expensive?
Yeah. It's at $1,557 now, and that was 2004.
Let's talk about using your 8 pillars to defining the health of a company and a stock. Let's talk about Google. Pull up the financials. Pillar number 1, we need revenue growth over the last 5 years. I'm certain this is absurd.
I'm sure it's absurd. So we pull up our trusty Y charts. Again, you can get this anywhere for free, a lot of places for free. Just Google financials for free. I don't care. So anyhow, go wherever you want.
You used to go into this full shtick about just go get it. Okay?
Just go find it. If you can't find it, then F yourself. 67 million, 90 million, 110, 136, 160.
You said million. We're talking billions.
Billions, here. I'm sorry.
Billion. Billions and billions and billions. So that's incredible.
I mean, that's absolutely incredible. And the other thing is, look at this. 2010, 28, 36, 44, 51, 59. They've never had a down year in revenue.
Okay.
So is that an emphatic yes on the
yes.
The revenue growth? Okay, next one is net income, right? 16 billion, 19 and a half, 12 and a half, 31, 34.
Seems
we
good
have a
me.
small dip here, actually a big one. Because of this big dip, I got to think something happened. Mm-hmm. But what's the trend here?
Upward.
Yes, so we're okay on that one.
Number 3 is free cash flow growth, which is cash from operations. Less operating expenditures.
No! Cash from operations. Cash from operations includes the operating expenses.
If you follow our podcast.
I can't believe you got the first part right, though. That's impressive.
If you follow our podcast, I can never understand what free cash flow is, but I almost had it there. So
you did. You had half of it. Okay,
yes.
So free cash flow is cash from operations.
Minus operating is something.
No, capital expenditures.
Capital expenditures,
That's
of course.
the money they put in. That's the money they invest back in their fixed assets, to be simple about it.
Invest in this show right now by clicking the like button, pretty please. I'll tell you this. I'm going to go ahead and put up a picture of myself, a very young photo of myself in a sports outfit. And you can see, you cannot not like this photo. So please smash that like button, support Everything Money.
I'd like to get me some of that.
Oh, baby. You know I had a rat tail when I was a kid, Paul?
Did you really?
Like it curled like a little piglet tail out the back? Yes.
I'm getting messages on Dynasty Owner app from Don right now. That's okay.
Okay, talk about free cash flow. With this cash from operations minus
capital expenditures.
Capital expenditures.
And capital expenditures is the money they put back in their fixed assets, to be very basic about it.
Go ahead.
Okay? This is a big metric. Free cash flow is what they use to buy back stock, pay out dividends, pay down debt, all these things that will make a company better. The better the free cash flow, it's hard to... You can make up free cash flow. There's ways to do it. But overall, free cash flow and net income will equate each other. So, go over the last 5 years. We had here 17 billion, 26 billion, 24 billion, 23 billion, 31 billion.
So, growth over the last 5.
Yeah, definite growth. It's almost doubled. And there are ups and downs, of course. But look at the previous ones: 7, 11, 13, 11, and 12.
Growth.
Definite growth.
Okay, we got 3 green check marks for very good.
3 already. And they're not even just good. They're phenomenal.
I would assume the pillar number 4, the PE ratio, is bad. Because if everyone knows about it, Paul, you're probably not going to be investing in this company. So
That's very astute of you.
I would assume this is overvalued. We want a PE ratio of somewhere around 15 to 20. What is that? 50. What is that number?
34.
34. I mean, it's not absurd like a Tesla.
So now here's the funny part. This is one that I'm not 100% turned off by necessarily. This is what I'd put into my analysis because the growth in the profit is so good and the growth in the free cash flow is so good. The question becomes, do I think that growth is going to continue at a rate that will justify a higher PE? PE in and of itself can tell you things, but if you don't understand the story behind it, you don't necessarily know if it's good or bad. This is still going to be a red X on PE, but I'm not exactly saying no. I'm sitting there saying, okay, let me go understand more about the company to see what kind of growth are they going to have in the future. Their growth in the past has been phenomenal, but the bigger and bigger you get as a company, the harder and harder it is to grow at higher rates, right?
Yeah.
Is it more likely that a company that does $100 million in sales versus $160 billion is going to grow faster? Which one's more likely to grow fast?
The lower one.
Correct.
I'm thinking to myself, what else can Google do? I mean,
well, they haven't touched the rest. I mean, look at China. They don't even have Google. Isn't Google like banned in China?
oh, okay, I don't know.
I think it is. They have their own, search engines. I mean, how much of the world is still not even developed yet?
I see.
Right? So there's still a lot of potential for Google in the long run.
Wow, you're right.
Okay, next one.
Pillar number 5 is total current assets greater than their liabilities.
This one I know for a fact is incredible.
Oh.
Incredible.
Their assets over liabilities?
Incredible. Now I'm going to go to the quarterly data to see the most recent one. Incredible. You ready?
Okay.
Balance sheet. That's where we're going to get our total current assets. Total current assets is basically cash on hand. To make it very simple, it's your cash on hand. What do you see there?
100 and something billion?
149 billion.
Oh my gosh.
Okay. Total current
Liabilities.
43 billion.
Triple.
Over triple. So they can take all their cash right now, pay off all their current. Oh, here's even better. Their total liabilities is 71 billion. So they have 149 billion dollars, 150 billion dollars in cash, and they owe as a company in total 71 billion. That's like you at home having call it $1 million in your bank account, and on your car, your home, your credit cards, and all your bills, total.
Your home?
Home and everything, you owe like $400,000. Would that be a good position to be in?
I would think so.
This is the most emphatic green check mark I think I've ever had to give on anything. This is phenomenal.
Pillar number 6 is price to free cash flow, less than 15.
So the free cash flow, if you remember, was 31 the last year. 31 billion. Price to free cash flow. The market cap is 1.59 trillion divided by 31. What is that? 33, call it 30. What's the number? It's 30 plus.
Okay. We need it around 15?
Yeah. So it's over double. Again, so far we've had PE and by the way, what is the number here, by the way?
That number?
Yeah, 1059 divided by 31.
Oh, sorry. 1059 divided by 31 is 34.16.
Okay, and guess what? Look at their PE, 34.25. It's almost exactly the same, which over long periods of time, price to free cash flow, and it should be pretty similar.
Okay.
So again, if you believe the growth can continue at a higher rate and you have a model that'll show you, hey, what kind of if earnings and revenue are growing at 30% a year, should you pay more? Of course you should.
Yeah.
Because it's going to catch up. If you believe the next 5 years is going to be 30%, the question is, what is it going to be? I don't know. The one concern I will have that I will say about this, that I didn't like about Google, this is one thing I did not like about Google. Their income statement, if you look, their revenue since 2015, do me a favor, Seth. What's 160? 161 divided by 67.
2.4.
Okay, so their revenue is up 2.4 times in the last 5 years, right? But their profit, this is that I don't like. Their profit is only up double. It's not terribly off, but one is up 2.4 times, one's up 2 times. Usually, in a company like this, which we'll see in a little bit, has a high margin, as their revenue increases, their profit should increase at a faster pace. because more money is being put into the profit. Now, there could be a reason for that. They could be investing in a lot of other businesses that have, because Google is very open about that. They say, hey, listen, 97%, 98% of our revenue is from Google, the search engine. 3% is from our other projects that all lose money. Like as a whole, those 3% lose money. How much? I don't know. So that could be a big part of it. They might be putting more money in their projects that don't make money because they're trying to, Google's like Apple. They're trying to make sure people are immersed in Google. You don't ever say to somebody, hey, go to the internet and go search for this. What do you say to people?
Google it.
Google it. It's a verb now.
Yes.
Right? So they're trying to make sure everybody's immersed in that one. I'm not saying that's a terrible thing. Again, this is where analysis is important. Going to understand deeper, why did profit only double when revenue is up 2.4 times? So profit's up 100%, revenue is up 140%.
Let me chime in for our visitors on YouTube. Is that Paul is coming up? I want to be very clear that Paul is coming up with all of this off the top of his head. This is not scripted at all. We had actually no plans to even analyze this stock about 17 minutes ago, and here we are. And so if you're watching shows that seem incredibly overproduced and incredibly scripted, they are. And this one is right off the top of Paul's head. So if you need
that, what should they do?
If you like that, you should call Paul, and here's his number. Well, it's 216. No, if you like that, like and subscribe. Hit that like button, pretty please. But yes, ask questions down below. Paul will answer them with a hashtag.
Yeah, I wing all of it because the thing is, I have my system that works for me.
Yes.
I have this I just go run through it. And in this time that we've already taken to do this, I could have done 10 companies on my own because I just rattle right through it. Mm-hmm. That's the experience I have with it. But these are the things that I think about. I don't sit there and you've heard me say on Google, we've had 2 major X marks. But both of them I didn't say these are definite, I'm not even going to touch this. They were both Google's a fast-growing company. Let's see what they're trying to do.
Let's look at pillar number 7, profit margin greater than 10%. I assume this is high being a tech company, or is that what you call it?
Advertising company. I mean, basically they're advertising. What does it cost to put up an ad on Google? Look at their profit margin. After taxes, 18%. Something interesting, their gross profit is 52%. What's gross profit, Seth?
I don't know.
Basically, for every extra dollar they make in revenue, how much should go to profit? 52 cents goes to profit. Now, that's why I was confused as to why the revenue growth is up 2.4 times, that the profit's only up double. Because they have a really high gross margin. Every extra dollar revenue should be growing their profit by 50%.
What about decreasing number of shares, the final pillar number 8?
Oh, this one I actually don't know. What would your guess be? I actually don't have a clue on this one.
I would think they're increasing shares.
I would think they're decreasing because of the free cash flow being so high, so much cash on hand, that they're buying shares back. That would be my guess.
Okay.
Oh, increasing it is.
Increasing.
So they had 636 million in 2010, 645, 655, blah, 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 692 million shares outstanding now.
So not really good.
It's not terrible. They've diluted by about 10%. So if you had 10 shares before, the equivalent now is 11 shares represent that are now existing for the 10 shares you had before. Mm-hmm. So it's not, if you had about a 10% reduction in your value. Is it terrible? I don't know.
So through all of this, you've never actually looked at the price of the stock. Where does that factor in with all this? It kind of doesn't matter at this point?
No, it doesn't matter. Price is, when it comes from a value perspective, I don't care about price at all. I care about, I shouldn't say that. I don't care about price until I look at it and say, okay, what do I think it's worth? And then I determine what it's worth and say, is this higher or lower than the price it's currently paying? Asking on the market.
So a year ago it was $1,200. It's currently $1,550.
Yeah, you want to see an incredible chart? Go to 10 years.
Wow. So
Google will be my portfolio at some point in the near future.
Not now, though.
Not now.
Why?
But by the way, I shouldn't say not now for sure. This is me being a market timer, and this is not what you should be doing. I look at it saying the tech market is so hot. Right? Look at NASDAQ today is down. How much is the NASDAQ down today? Look at Google today. It's down 2%. So I look at it saying there'll be a time. Look at year to date. Mm-hmm. It got down to what at this point?
Well, that was a complete collapse of everything, Paul.
Correct.
But it could happen again.
It was 1,056.
Wow.
I look at that saying, okay, this is a company that has a lot of good potential. I think it's going to be around for a very long time. I think they're going to dominate the market and grow. And I think look at going, maybe 1,000 is the right price for it. I haven't run into my analysis yet, but with the growth potential, I'd want to understand. So now we can go to quarters. I'm going to go to the quarterly look and say, well, how does it look this quarter versus the most recent quarter? So in June, of 2020, it did 38 billion in revenue. In June of 2016, it did 38.7. So the revenue isn't that much higher. It actually didn't grow in the last year. That's a problem. In the first quarter of the year, it did 41 billion versus 36. So it grew there. So obviously the second quarter was a lot lower revenue growth because they rely on advertising dollars. And advertising was probably pulled back when the economy retracted, right? They're actually down in revenue. That was probably one of the first times they were down in revenue from one quarter to another. The same quarter from a year before. So these are things to understand. Google is great, but if there is a recession again, the revenue is going to pull back. It's going to have to because they rely on advertising.
Is there a certain price where you might expect a stock split in that it's kind of high?
Good question. I don't know.
And
You would
unattainable
think.
for normal
I'm surprised
people?
they haven't split yet.
Yeah.
Have they ever split?
I don't know.
Can you look that up? I don't think they've ever split, actually, come to think of it.
Let's see.
Have they ever split?
The first split for Google took place in March of 2014.
Oh, did it really?
This was a 2002 for 1,000 split, meaning each 1,000 shares went to 2002 shares. So
2 for 1. Okay, got it.
yeah.
All right, well, that's what it is.
Okay. Google. There it is, folks. Buy if you like.
85% of the revenue is from online ads.
85%.
Yeah,
It's amazing.
yeah, they're great.
What's also amazing is the fact that you watched the video the whole way. Like and comment,
Did we get all
subscribe.
8 pillars on there?
We did.
Excellent.
Yeah. Decreasing shares is our last one, Paul.
I'm still, that X, it's only by 10%. It's only increased by 10% for a fast-growing company like Google generating such significant cash flow. If you can buy it at the right price.
Yeah, it would seem that
I'm not as
Google,
worried.
when you say that, like that Google hasn't touched China or I don't even know, all of Africa,
Of course not. Africa hasn't been touched.
India.
India, Africa, and China alone is how many people? Half the world's population, easily? No, more than that. No, probably half the world's population.
Oh no, Southeast Asia. Remember that circle? There's more people inside than outside. Yeah, they draw a circle around.
Okay, so
like
China's
India, China, and Southeast
China
Asia.
1.6 billion or 2?
I don't know.
Well, the world is
India's
7.
1.
Yeah,
China's easily 1.
no, China's 1.6 or something.
Wow.
So we're talking about 2.6. Africa's how many?
Oh my God.
All right, either way.
It's amazing.
Yep.
So there's definitely room to grow. So I would buy, Paul.
Go ahead.
Yeah,
I don't know. They've got good freight. Listen, this company's not going anywhere.
that's true. Unlike Yahoo.
Yahoo's still around.
Thanks for watching us. Thanks for watching the Everything Money channel with Seth and Paul. See you guys.